Federal Reserve officials just had a very private, closed-door meeting with the insiders of the global banking cartel, signaling the Fed is about to do a new round of QE. I'm going to reveal exactly what happened, why they're likely going to do this, and the, let's say, unintended consequences in 3 simple, fast steps. Step number 1, let's go over these liquidity problems. If you have been watching CNBC, Bloomberg, the financial media, or even social media, I'm sure you have been hearing a lot about these liquidity problems in the financial plumbing.
Liquidity has dropped sharply.
Market liquidity over the past couple of weeks, I think there have been headwinds building.
So let's start by looking at a chart going from today's date all the way back to Q1. This is 2025. On the left, we go from negative 20 basis points, here's 0, all the way up to 30 basis points. Now this looks like a very kind of benign looking chart. So I'm sure a lot of you are saying, yeah, George, well, I don't know. What's the big deal? Okay, so right here, I want you to focus on this 0 mark. Because usually, or what we've seen throughout the beginning of the year, is the repo rate is trading under IOR. What is IOR? IOR is interest on reserves. And if you don't know what that is, that's fine. I'm going to explain it throughout the rest of this video. Most of you know what the repo market is, and it's probably infamous in most people's minds for blowing up in September of 2019. But what's really scary right now is the same cracks in the system that we saw in 2019. We're seeing them again today. So getting back to this blue line, this represents the spread between the repo rates and interest on reserves. So throughout the beginning of the year or into Q3, the repo rates were lower than IOR. That's why you had a negative spread. But look at the trend. Look at what we have seen more recently, where the difference has gone right back to 0, to where they're at par, but it's gone higher and higher and higher, where now the repo rates are actually higher than interest on reserves. That's a very big deal. So why does it matter? Editor, go ahead and throw up a chart of interest on reserves. And what I'd like the viewers to notice is usually the Fed funds rate. And this represents the rate that banks are lending to one another is slightly lower than interest on reserves. So why that matters is because this interbank lending rate called Fed funds is unsecured. There's no collateral involved in the transaction. But with a repo transaction, it's actually collateralized, where most of the time the lending party gets a US Treasury in return for collateral. So why would these secured collateralized loans be trading at a higher interest rate than not just IOR, but more importantly, Fed funds, which is unsecured, meaning there's no collateral in that transaction? The answer is actually very easy if we use some good old-fashioned common sense. So let's say you had 2 buddies. One of them is a deadbeat. He never pays anyone back. And the other guy, let's say his word is as good as gold. Whatever he says, he does. And both of these guys come to you and say, look, little strapped on cash, can you lend me $1,000? Well, the deadbeat guy has some collateral. The other guy doesn't have any collateral at all. But you know there's a 99.99999% probability that he pays you back. Who are you going to give the better interest rate to? You're probably going to give a better interest rate to the guy who keeps his word versus the guy who never pays anyone back even though he has some collateral. Why? Because the risk is a lot higher with the guy or the entity, the financial entity in this case, that actually has the collateral to pledge in this type of loan or this type of transaction. And although this makes a lot of sense, it's the complete opposite of what you hear in social media and in financial media. They always say that if we see signs of tight money in the financial plumbing, it has to be a result of there being too few bank reserves. There's just not enough money. as though counterparty risk doesn't even factor into the equation. Now let's go into the details of exactly what happened during this, let's say, suspicious meeting between Fed officials and the global banking cartel, which I think will lead to a new round of quantitative easing. This will also shed light on why we're having these liquidity problems in the financial plumbing that could lead to something like we saw in September of 2019. If it is just a lack of bank reserves, then QE may solve the problem. But if it is a result of counterparty risk increasing, then QE isn't going to do anything in terms of the financial plumbing. But then we have to ask the question, will it lead to inflation? Will it lead to deflation? Will it lead to the stock market going to all-time highs or collapsing? And what on earth will happen to interest rates? That's exactly what I'm going to reveal to you throughout the rest of this video. Step number 2. Now let's go right over to the Financial Times and get into the juicy details. The New York Fed convened meeting with Wall Street firms over key lending facilities. So what they're talking about here specifically, this may have been kind of the story they were telling the media, is that it was all about the Fed's standing repo facility, because we have seen usage really increase, which in and of itself is a big, big red flag. Let's keep going. New York Federal Reserve President John Williams convened a meeting with Wall Street dealers this week over a key short-term lending facility. That's what we just talked about. The meeting was arranged hastily. That's never a good sign. Williams solicited feedback from primary dealers. So let me just break through all the noise here and give you the signal. The ruse is the New York Fed is trying to come out and say, well, we just had this meeting because we want to get the opinion of these primary dealers, the insiders in the global banking cartel, as to how we could improve the standing repo facility, how we could get more people to use the standing repo facility. Why would they do this? Because they're worried about losing control over repo rates in the real repo market, not just the Fed's standing repo facility. So let's back up here a little bit. We've got the repo market. You always hear about this in the news. You hear about this in my videos. And that's a repo transaction between two counterparties. Well, you can also do a repo transaction with the Fed being one of those counterparties. And this is how they try to put a ceiling on interest rates. So as an example, let's say the interest rate right now for a repo transaction, if you want to borrow money from the Fed, is 4%. That's not it, but let's just say it's that for the sake of this example. Then, if the real repo market was charging you 4.5%, then you'd say, well, why am I going to take that? I could just go over to the Fed. So then with the repo transactions, the Fed tries to put a ceiling, like we just said, on rates. But what's really interesting is we see the obvious concern from them, and I think that's what this meeting was all about. And you would say, well, why on earth wouldn't someone just go ahead and use the standing repo facility from the Fed? Because of what it implies. More on that in just a moment. Let's get back to the article. They say the closely tracked measure of short-term borrowing costs, known as tri-party repo, that's the real repo market, jumped well above a rate set by the Fed last month. Tri-party repo rates have again picked up this week, rising to almost 0.1 percentage points, 10 basis points, above the Fed's rate on reserve balances. That goes back to the chart that we went over in step number 1. Now check this out. This is a quote from Roberto Pirelli, the head of the New York Fed's market operations. The share of repo transactions taking place at rates above IOR has reached levels last seen in late 2018 and 2019. Remember what happened in September of 2019? The Fed completely lost control of interest rates, where they spiked all the way up to 10% and almost took down the entire system. They say analysts have warned that they expect further bouts of pressure coming in weeks ahead. This is the liquidity problems that you've been hearing on the news a lot lately. After 3 years of quantitative tightening, QT, banks have little excess cash. So you see what they're doing? They're pushing this narrative that, no, counterparty risk. No. That's not what this is all about. This is just the fact that the banks that create the money just ran out of money. Seems a little odd, doesn't it? Let's keep going. Lenders are often loath to use the facility. And here's where we get to the really important part, fearing that it could signal to the market that their institutions are under pressure, even though names of borrowers are only made public 2 years after they tap the facility. Let's think this through. If risk didn't go into the decision-making process as to whether or not a counterparty was willing to lend to you or at what interest rate, then why would these financial institutions be worried about it? You see how this doesn't really add up once you scratch beneath the surface. And let's keep going, and what you'll see is further and further proof that risk, counterparty risk, actually does matter a lot. And I would argue it matters a lot more than the amount of bank reserves that are in the system. And of course, the money tightness or the lack of liquidity that we've been seeing isn't just because of QT. It's much, much more about the, let's say, cockroaches that Jamie Dimon talked about, the counterparty risk increasing in the system. So what would you do if you're having to lend to that friend that's a bigger counterparty risk? You'd charge him a higher interest rate. But don't take my word on it. Let's look at what Thomas Simons, who's the chief U.S. economist at Jefferies, says. Right here, quote, repo is all about trust. If any borrower gets the reputation of being riskier, that's why they would go to the Fed's facility to begin with. It creates this perverse incentive for all the lenders to pull back at once, even if it isn't deserved. Once you get the stink on you, it's hard to recover. And one more thing I'd like to point out is the repo rate that is charged, let's say in tri-party repo, is an average of all the rates from the day. Where a lot of people think that, let's just say the tri-party repo rate for the day was 4%, that every single borrower got that 4% rate. That's not true. You could have some borrowers getting 4.5. You could have some borrowers getting 3.5. It's just the average. So what that tells us in and of itself is that risk is actually a big, big factor in the decision-making process. And the amount of bank reserves, not so much. Because obviously, if the sole decision was just about the number of bank reserves, you wouldn't have different interest rates for different repo transactions with different repo counterparties. So now that we've established why we've seen this lack of liquidity, which is eerily similar to what we saw at the end of 2019, according to the Financial Times, we have to ask, what's the Fed going to do? Well, we've only got two options with the Fed. They're either going to drop rates, which they're in the process of doing anyway, or they're going to do quantitative easing. Those are really the only two tools they have to address this. And at the end of the day, they know darn well this isn't a mechanical issue, but they have to pretend as though they really matter because it's all about the psychology. And this is why, although there are no certainties, only probabilities, I think there's almost, let's say, a 99.99999% probability that the Fed once again does quantitative easing because they can't let this get out of control and they have to look as though they're actually doing something. Step number 3. So let's assume I'm right. The Fed starts quantitative easing again. What will the outcomes be? Will we see big inflation, maybe deflation? Will stocks go up? What about interest rates? What about the dollar? I didn't even put the dollar up there. But we can go ahead and talk about that as well. Here's my prediction as to what would happen if the Fed does quantitative easing, another round of quantitative easing. We've got to start by looking at what's happened in the past. So let's look at a chart of bank reserves, because again, the reason the Fed, or the reason they would give you as to why they are starting another round of QEs because lack of liquidity. Therefore, we need more of these things. So chart from today's date going all the way back to 2000. On the left, we go from 0 all the way up to 4 trillion. So you can see, interestingly enough, there really wasn't that many reserves up until the GFC. So then what happens, we get the first round, we get the second round, we get all the way up to the third round here, to where we had about $3 trillion in bank reserves, and prior to the GFC, we had about 40 billion. Now what's crazy is that also included vault cash. So the amount of electronic reserves, which is what we should focus on, because that's what they're using, theoretically, for interbank settlement, was only $10 billion. So we basically go from $10 billion up to $3 trillion. Well, what happened during this time? Well, the stock market definitely went up. That's for sure. So if the Fed does another round of QE, are stocks going to go up? Maybe. Because what did stocks do when they reduced the amount of bank reserves? Did they go straight down? Not really. Editor, go and throw up a chart and let's see if there's any correlation between this big down move when they did quantitative tightening and the stock market. And then let's also see if there's a big correlation between this round of quantitative tightening when they're reducing the amount of bank reserves and the stock market. In fact, I know this one right off the top of my head. Is the stock market higher today than it was back in, let's say, 2022? The answer would be yes. That's for sure. And let's actually go back even prior to 2000. I always like to point out that the stock market in the 1990s went up by a higher percentage than it did from 2010 to 2020. Meaning that when there were absolutely no bank reserves, almost no bank reserves, 10 billion, let's say, in bank reserves, the stock market went up by a higher percentage than when we were doing this. So I don't know if there's a causal effect with bank reserves other than maybe just psychological. But I don't know if that's even true, because then we have these rounds of QT when there's really no correlation, almost an inverse correlation with the stock market. Okay, so what about inflation? Well, how much inflation, meaning consumer prices going up? I know a lot of Austrians are like, this is money, this is inflation, this is the definition of inflation. Okay, well, for the normal person that's watching this video, it's all about prices going up. So what was the rate of inflation from, I don't know, here to, let's say right here? Did the rate of inflation or consumer prices, I know they went up, they definitely went up, but did they go up 100x, which is basically what the amount of bank reserves did? No, I don't think so. And then right here, were prices coming down? No. And then here, were prices going way up? Oh yeah, definitely during the cerveza sickness. But more recently, have prices come down? No. So the punchline here is I'm not sure there's a real strong correlation with inflation, the CPI, we'll use that as a proxy, and the amount of bank reserves in the system. Now, what about interest rates? Because we know the Federal Reserve controls interest rates. Or do they? Editor, go ahead and throw up a chart of what the 10-year Treasury did during QE1, QE2, and QE3. We see that interest rates on the 10-year Treasury actually went up, not down. The exact opposite of what the Fed was trying to get the 10-year Treasury to do by buying those treasuries, which they had to print the bank reserves to do to begin with. And then how about from 2022 to today's date, when they reduced the amount of bank reserves dramatically? I mean, let's say by about $1 trillion. Did interest rates go up then? Nope, they went down. So the exact opposite of what you would expect. So what actually moves interest rates? This is the key right here. Well, it isn't really this, or what the Fed's doing, especially not at the long end of the curve of the 10-year Treasury. It's actually this. Inflation, growth in inflation expectations, which again have nothing to do with this. So you see what I'm getting at here. What really matters at the end of the day is how the marketplace perceives the macroeconomic conditions. And if the market perceives the macroeconomic conditions as, let's say, disinflationary, then guess what? Interest rates are going to go down regardless of what the Fed is doing. And if the marketplace perceives growth and inflation expectations going up higher in the future, then interest rates are going to go up, regardless of what the Fed is doing with their balance sheet. So if the Fed does another round of quantitative easing, stocks, inflation, rates, and the dollar will do exactly what they otherwise would have done with or without the Fed and their bank reserves. Now, I know a lot of you right about now are watching this video and saying, okay, George, I get it, but I mean, how does this really pertain to me making money or setting up my portfolio? I mean, this is a neat little thought experiment, and yes, you've kind of proven your point, but at the end of the day, is there anything actionable here? Well, I've got good news for you. I have a private investing community that I've set up with my good friends Chris McIntosh, Brent Johnson, just to name a few, where we do our very best to help the average investor just like you not only protect your wealth, but grow your wealth in these crazy, uncertain times we live in. If you want more information on Rebel Capitalist Pro, we'll put a link in the description below.